Bank of Canada just dropped interest rate by another 50 basis points. How will this affect Canadian real estate market? Hi everyone, Ilan here. So this is on the headline. Everybody's, very excited or worried about how Bank of Canada just reacted to the most recent unemployment and the GDP data and decided to drop interest rate down another 0.5%, right? That's huge because if you look at the screen, this is the basically second time we've had a jumbo cut, right? They call these 50 basis point jumbo cuts, like a quarter basis point, 25 basis point, quarter percentage. Those are small cuts, right? So we've had a small cut in June, and then another small cut in July, another small in September. So 3 cuts earlier this year, and then 2 jumbo cuts, right? October 23rd and most recently December 11th, which is today. I'm filming this video today. You might see it tomorrow. But we can see that Bank of Canada has really taken that aggressive approach, right? And it's deviated from the US Fed rate by even further. So US has only dropped interest rate so far by 2 times this year, right? Only 75 basis points. But now we've dropped by 1.75%, right? So a whole percentage more than the US Fed rate. So right now, US is at 4.75 and we're at 3.25. Okay, that's a huge difference, 1.5% of difference. So this will definitely further pushing the Canadian and US dollar exchange even further, right? And affect our economy in many different ways. And this can show that Canadian government is really worried about the Canada's economic status, right? Like we are suffering, like we're losing jobs. Unemployment rate, you can see on the screen, it's 6.8%, and that's above the expectation for 6.6, right? Even though we did well in terms of full-time employment gain, we did gain 54,000 full-time employments, right? But another study shows that a lot of these are from public sectors, like government workers, and they're calling to cut more government workers, right? Just like, what the US is doing. Because, but I mean, the gain on the jobs, it's mainly reliant on government public sector jobs. That's not a good sign either, right? We're probably spending too much there. And comparing to US at 4.2% unemployment rate, we are quite much worse, right? In terms of our jobs. And our GDP, you can see that we've gained 1% quarter over quarter annualized, right? And annual growth rate, if you're comparing to Q3 against last year Q3, our GDP has grown by 1.5%, which is not terrible. It's actually, you can see like a upward trend, like we're growing a bit better year over year. I mean, our inflation rate is about 2% right now, right? So if our GDP grows by about 2%, then we are okay. Like our wages and our personal consumption, like where our spending is actually in line with the inflation increase, right? So we're okay, like we're making more money and stuff are more expensive, right? So we're still okay, but if it gets worse, it's going to be much worse, right? We don't want to see our GDP growing at 1.5% and inflation is at like 4%. Then everybody's suffering, right? Our spending power gets reduced a lot. So it's a good thing our inflation is in check right now, but our GDP growing slowly at annualized 1%, 0.3%, quarter over quarter, is still lagging, right? So combining these 2 pieces of data points, the 6.8 unemployment rate and the slow GDP growth, and that's why Bank of Canada has decided to take another jumbo cut. So in terms of how it affects our economy, we'll talk about how it affects our real estate in a bit. But if you just look at the Canadian dollar and US dollar exchange rates, you can see that we've been suffering already, right? Ever since the beginning of this year, or even like last year when Canadian and US rate cut like progress has really deferred, right? Our exchange rate has been suffering, especially the most recent half a year, where we take these jumbo cuts while the US has not done much. You can see it's dropped even further down, right? So, and the interesting thing is today, after the rate cut, everybody's expecting, oh, okay, our mortgage rate is going to go down. But so far, now it's, when I'm recording this video is past 5 p.m., right? You can see that today, the bond yield has not dropped. So the market has not reacted, to this rate cut, or perhaps the rate cut is already priced into our bond yield, right? Which is everybody's having a pessimistic view on the economy. Therefore, the bond yield is behaving a bit unusual, right? Like you can see the the yield curve right now, we have a flat yield curve right now, which means people are not expecting a lot of rate change in the future. And they think short-term risk and long-term risk are about the same, right? Last year, this time, we had an inverted yield curve, which everybody means are more pessimistic. Right now, investors are confused, right? From this flat yield curve, you can sort of tell that nobody knows what's going on. People don't know what's going to happen, right? Which is true. And that's the fact about Canadian real estate, especially Toronto real estate as well. If you ask me, I honestly say, I don't know. I don't know what's going to happen next year. But I can tell you, rate cuts in general, in the short term, it's a good thing, right? For the real estate market, especially in the Toronto market where it's so expensive. The real estate prices are very expensive. People need these rate cuts to even survive, right? To even considering buying a home, right? It's not like, in small towns where properties cost like $300,000 where everybody can buy one, right? Even if monthly payment goes up a bit, who cares? They can still afford it. But in Toronto, people are barely affording like even entry-level homes, right? So these rate cuts are definitely much needed for those who do plan to make a purchase. So you can see in October, we've already seen a jump in terms of number of buyers who decided to buy a property. And November, we continue to have this heightened sales level, right? And before that, you can see before the jumbo cuts, we had very sluggish transactions. And even earlier this year, ever since March, you can see that, even though we had a little peak in spring, but generally we are lagging in terms of number of sales comparing to last year, right? This light blue line is last year. This is this year. So we've been having lower than last year's sales up until when we started have these jumbo cuts, right? This is the first 50 basis points cut. Okay, so that's when it happened. So when we cut another 50 basis points right now, I would think sales will continue to be okay, right? We're going to have a pretty good number of sales in the short term, okay? But you can see sales does not mean better prices right away, right? It just means, there's a higher likelihood that existing inventories can be reduced a bit, right? Like there's more buyers clearing out some of these existing inventories. But because we have such a high level of existing inventory, right? These sales are not going to clear them out. It will maybe help with the pressure, but it won't clear them out right away. So prices may not jump like it usually does in the spring market, but I do think in the short term, let's say the next 3 months, we will get a good number of transactions going on, right? Prices, I'm not sure how much it will affect it, but we will have more buyers in the short term because another big jumbo rate cut. Okay, so that's good. That's a good news for GTA real estate market. But in the medium to long term, like if you ask me what's going to happen second half of 2025, right? Or 2026, I do worry that with all these moving pieces like Trump threatening a 25% tariff on us and our sluggish economy, like our high employment rates, there's a lot of risk events, right? Like I do think we could be facing a major session of layoffs, right? For companies who do rely on the US market a lot for their revenue. Whether the 25% tariff will happen, I do think Trump in general, he is someone who is going to have policies that improve the US economy at the expense of other countries. Canada being the neighbor, we will be one of the first ones to be affected, right? Along with Mexico. So be ready, right? Be ready for, I would say, some bigger black swan events. That's low in chance, but big in impact, right? So these events you should be prepared for. So if you want like one piece of advice from me, I would say be ready for both scenarios, right? Where the best scenario is next year, we have a strong spring market and market continue to recover as we drop more rates. Great. Then, your real estate, you can finally sell them or you can continue to see your property values go up, which is good, right? But be prepared for the worst case scenario where we do have a bigger recession. Nobody can afford to purchase real estate. Even if with the rate cuts, people still can't afford it in GTA and people losing their jobs, they have to foreclose their homes and we do have to have a lot more inventories and price keep dropping. So in that case, what would you do, right? How would you deal with this whole scenario where, at the same time, the stock market could be affected too, right? Remember, if there's a tariff on Canadian goods, it will affect our TSX, right? Like our big companies' stocks, they will drop, right? Because their revenues rely on the US, now it's decreasing. So when our stock portfolio drops, your savings may shrink as well. And for people who plan to use that to maintain their properties or buy real estate, they'll also be sort of affected interchangeably, right? So it's not only the real estate market that will suffer. So in that case, like how would it impact your own portfolio, right? If you have a lot of high leveraged real estate and you rely on these, let's say, tenants to pay your rent, to barely even cover your interest. If these tenants all of a sudden lose their jobs, how would you handle your real estate portfolio and the safety of your investments, right? So, be prepared for both scenarios. And if you have to choose, right, I would say rather not maximize, you don't have to maximize every part of your gain by reducing your risk level so that even if you miss out on some gains, but you're okay on the downside, so you don't lose your shirts, right? If the bad scenario happens, right? I would say just keep in mind, don't lose your shirts. Even if the economy becomes really bad next year, real estate price drops, you're okay, you're not going to lose your shirts, then you're in a scenario, right? Prepared well. You've managed the risk. Okay, so I would say that's the important message. Okay, so thank you for watching. Just wanted to share my quick thoughts about how today's rate drop news. And these are I know it's very scattered thoughts, but I just wanted to share quickly what I'm thinking. So hope this helps. Until next time, ciao.